Don't have any entry-level positions available?
Nah, we're looking for upper management and senior project leaders.
Now, before we dive in, just a quick reminder. This video is for informational and entertainment purposes only, and should not be considered financial advice. Our full disclaimer is shown here and on our website. Hello everyone, and welcome to another episode of us reacting to TikToks. So today's TikToks are going to encompass a few key items. The first one is going to be related to business expenses. The second one is going to be more related to financial investments. And finally, the final topic is going to be more career focused. So let's see some TikToks today and see what these experts have to say about finance and what could benefit you. So this first video is from Mark J. Kohler. Let's see what he has to say about putting your house into an LLC.
I'm gonna put my house in an LLC and rent it. Does my LLC need to buy the house from me?
If you want to convert your home into a rental, it's a great strategy. Move out, put it in an LLC. Do not worry about the due on sale clause. Banks don't care. As long as you keep paying the mortgage, they're done. They're cool. And again, you're not changing the underlying ownership of the property. You still own it. But you're going to do a contribution. You're just going to contribute it to the LLC, put it on the books, start depreciating it, and it's a great strategy. You may even Airbnb it, which is a great option. You got the sale of home exemption, and you could sell it within the next couple years tax-free as your sale of home exemption. You want to decide, how long am I going to keep this as a rental? I'm going to keep it as a rental for the long haul or not. So don't sell it to yourself. No, just contribute it.
If I move and want to put...
So let's go over some of the points that he mentioned. The first piece is for the rental piece. Usually you can actually buy a home as a personal home. Like basically you're going to be living in it. You could buy a single, you could buy a multi. It's completely fine. You can actually purchase this and say you're going to be living in it. And there's usually a clause in the mortgage agreement saying if as long as you live in there 1 or 2 years, depending on the mortgage provider, you can then move out of the property and then rent it or do whatever you want with it, essentially. As long as you don't impact the value of the home, then the bank will be completely fine with you renting your primary residence. So, the next component, converting now your house into an LLC. Why do people do this? The reason people convert their property into an LLC is for liability purposes. Usually, if you have a home in your name, you effectively have unlimited liability against any claim that may go against you. So essentially, if someone sues you or you do something to someone, they may sue you for not just all the assets you currently have, such as your house, your money in your bank, everything effectively. Now, if you actually try to contribute this to an LLC, which is what most people do, usually they have one LLC per home, and you put that your home into this LLC, then it makes it a lot more difficult for people to then actually go after your property if it's sitting in its own LLC. However, there is a term called pierce the veil, where if they find enough fault in what you've done, they can actually go around this and still go after the assets that are in this LLC. This is just an extra layer of protection you can actually do to just make it so it's much more difficult for you to actually, go after your assets. Now, just to add one extra layer of information for everyone, there is something called a trust, which is an extra level of layer of complexity you could actually do, but it'll make it even more secure. What a trust is basically is that you put all of your LLCs or your properties in your LLC into a trust, and then you have something called a trustee, which will manage these properties, but it won't be in your name essentially. It'll be basically in a trust, which will make it much more difficult for people to actually, get into your assets and, get to the stuff that you own. So let's move on to the next video. So this next video is from Marvin_Francois. Let's see what he has to say about business expenses.
All the expenses that are tax deductible. The interest on your car note is tax deductible.
Boom.
Your car insurance, car washes. Yes. Car washes details. Keep your car clean.
Got you.
Repairs, maintenance, tires, oil changes, parking, tolls. All these expenses related to your car that you're currently paying from your personal account are now business expenses if you can prove that you're using the car for business.
Got you.
Here's a list of all the expenses that are
So overall, I agree with some of the points that he's mentioning where there are certain expenses that if it's about the the necessary and ordinary use of your car, then you can deduct that. So the most I would say it's, for example, like tolls, parking. I wouldn't say car washes in most cases would be it, but you definitely tolls, maintenance, and then parking and things like that. But what most people do is that they don't actually use this metric to actually do deductions for their car. You would actually have to use the mileage, which would be much easier. Usually the rate of per mileage is calculated with inclusive of tolls and other items. However, you have to be a little careful with what you deduct, because things that are deemed ordinary necessary for the upkeep of your car may not be always deductible. It has to be based on, like, is it for the business use and to keep the car in the condition you need it in order to actually drive it. The other thing is, in order to actually qualify for business use of the car, it should be not basically from your place of business back to your home. It has to be basically for business use, such as going to a conference or going to other items, in order to qualify for these deductions as well. So let's move on to the next video and see what our next content creator has to say. So this next one is Chris Cobb _chosen. So he's actually going to explain how you can deduct business expenses if you own a business.
Tax write-off works in 60 seconds. So here we have John. John just started his bakery. He loves making cookies. And at his shop, John is now making $10 every single month. But what most people don't realize is John is having to spend at least $3 every month in order to operate his business, because he has to buy his sugar, he has to buy milk, he has a building, he has to pay for that stuff. And so that's when the government, Uncle Sam, comes in and they say, John, I saw you made $10, time to pay your taxes. And John is like, whoa, Uncle Sam, I made 10, but I had to spend 3 just to run my business. So I only made 7. And that's what Uncle Sam is like, yeah, you're right, you only made 7. Well, just give me $2 in taxes and you can keep the rest. And the rest that he keeps is called a profit. And John has made $5 from his business after his expenses. And that's how a tax write-off works. The government will allow you to pay taxes on all the money that you make after your expenses. He spent 3, he had to pay 2, now he keeps 5. If you like this content, follow for more, and also comment below what you want to see next. This is how.
So let's walk through what he just mentioned. So basically a business write-off. So in most cases, unlike us who actually are like W-2 employee earners, we actually get taxed on the top line. So essentially whatever salary we get charged right away. All of our taxes are based on that top line. And the reason for that is because our salary is considered profit into its entirety to the government. We worked to get that salary, and that's pretty much all we did. We didn't actually have any back-end expenses, such as like like maybe apartment, maybe driving, things like that, but those aren't considered expenses that are business related expenses. Those are just expenses necessary for you to get to your job and earn your income. However, for a business, they have a tax advantage where even though they've earned, let's say, $1 million in a year, they won't get charged taxes on that full $1 million. There is a lot of expenses that a business can take, such as, of course, just like the inventory costs, just like you mentioned here, but there's also a slew of other expenses, such as depreciation. Basically, if you rent a building, you can actually depreciate it, which is called depreciation expense based on the life of the building. You can actually take, salary expense if you have employees. There's a lot of expenses out there that a business can take first, and then whatever's left over is considered the profit of the business, and that's what's going to be taxed. And once that's taxed, then the rest of it goes straight into your pocket or goes back into reinvesting into the business. So let's move on to the next video and see what the next content creator has to say. Hello everyone, my name is Anthony and I'm the host of the Log Sanctuary. I hope you've been enjoying our content so far, and if you have, please feel free to like and subscribe. Also, we have our website up here, and we also have some socials down here, and as always, leave your comments down below. Alrighty, so this next content creator is MPTU. So he's going to be talking about career, so let's see what he has to say about it.
It's by AI and it's not important at all. No. Oh, how's your career going? What career? Don't you do something? I work at a job for money. Yeah, you wouldn't call that a career? Well, considering there's no upward mobility, it'll probably be replaced by AI and it's not important at all. No. Oh, I thought you made good money. I make shit, pal. I get paid in shit. Well, it's easy though, right? It's like an email job. Do you see the dark circles under my eyes? Yeah, they're allergies, aren't they? No, I'm dying. Oh, damn, really? Yeah. From what? Capitalism. Oh, very cute. I mean, I never thought I'd be one of these dipshits saying like, oh, capitalism, but for real, this shit fucking sucks. You get like benefits and health insurance, don't you? Oh yeah, it's great. $5,000 deductible. It's useless. Damn, why don't you just get another job? Because I'm lucky to even have this stupid fucking job. Like, no one wants to hire people in their 20s right now. Yeah, tell me about it. I tried to find a job forever. I just gave up. You gave up? What do you do now? Oh, I'm a criminal. I do crime mainly. Oh. How's business? Business is good. Do you think I could get in on this crime thing you got going on? I'd have to see your resume first.
You don't have any entry-level positions available?
Nah, we're looking for upper management and senior project leaders. How's your career going?
Alright, so kind of talking about what his key points. The first thing that I did want to mention is that he is completely right. You know, nowadays, in order to gain an entry-level position, the main thing that employers are looking for is experience. But we're kind of going back to the back and forth of like between a rock and a hard place, where if you don't have experience, you don't get a job. But in order to get experience, you need a job. So this is occurring in a lot of cases for a lot of new graduates, which I know sounds terrible, but some of the things that you could take advantage of, at least when I was that age, was something called on-campus recruiting, or OCR. That's one of the things that does help in terms of getting a job when you're fresh out of school or while you're in school, because the good thing about OCR, on-campus recruiting, is that you're only competing with other students usually, and that makes it so you're not in the bigger pool. So that's one aspect that you could do. Another thing is, of course, do enough internships in order to actually get enough relevant experience in order to see if you can actually qualify for a entry-level position in your career, of course. So usually a combination of these two does up the chances of you getting a job, or in this case a career, but overall it's still tough out there, and I completely understand in that regard. Now, in terms of his definition of what a career is. So a job is basically where you go in, you go in and you actually just get a paycheck. That's what's considered a job. A career usually is more involved in the sense of usually there's upward mobility, there's learning opportunities for you to grow as a person, and of course you earn more money along the way. Usually the earning the more money is, of course, primary for many people, but in most cases learning and growing yourself is effectively more important, because that's going to make you earn more dollars along the way either way. So definitely understand that if your job is not providing these upper mobility opportunities, then you need to move on and try to get a different job and see if they'll actually boost your career, and so you can continue to pursue and grow in your career. So let's move on to the next one. So this content creator is called FM Smith 319. He's going to talk more about like inflationary periods of housing and living expenses, as well as luxury expenses, and how they've changed over time.
Buying luxuries is because back in the 80s, luxuries were expensive, but life was cheap. Now it's been inverted. Our life is expensive, but our luxuries are cheap. So I think this is where the disconnect's happening. For example, in 1980, you could rent a great apartment for $200, but a television would run you $1,000. So if you bought 3 TVs, that would be $3,000. A CD player was $500. A cell phone was $2,000. A personal computer was $2,500, and a microwave was $500. That's $8,500. That is 3.5 years rent on luxuries. And $8,500 was also equivalent to a 20% down payment on a $40,000 home. So it was irresponsible if you didn't budget correctly to buy all these luxuries, because it could be holding you back. But today, it's flipped. Our biggest luxury is our rent for $2,000. We can now buy 3 televisions for $600. We have a Spotify account, cell phone for $1,000. You can get a computer for $500, a microwave for $200. That's about $2,400 a month. So our luxuries is about 1 month's rent, where theirs was 3.5 years rent. And if you want to put this onto a down payment, even if you took the average home of $420,000, let's bring it down to just $320,000, a 20% down payment on that is $64,000. So if you gave up all those luxuries, you would still owe like $61,000. This $2,400 of luxuries wouldn't even cover your closing cost of $10,000 on that home. So the whole thing's been flipped. So I think when they see us with the TVs, the avocado toast, and the cell phone, they think that's the reason we can't move forward. But why we can't move forward is because housing, daycare, college, and healthcare is so expensive, but those are our necessities. These luxuries are just fun little things that we have. And the reason the boomers...
So let's talk about some of the key points that he's mentioned. So back then, in the 80s and the 90s, the reason that all of these luxuries, as he mentioned, were more expensive is because they just came out. So a lot of the things were still being worked out. A lot of the kinks were still being worked out. So essentially, as technology advances, it actually becomes more affordable, but also much more advanced. It's all about developing the technology, putting more R&D costs into it, and making it much more affordable and much more accessible to the wider range of people. Back then, not everyone could even afford a computer, a CD player, and all these other items. That's why they were considered luxury items, because not everyone could even afford these kinds of things, because who was making that kind of money back then just to keep their head above water? Nowadays, it's actually much more accessible to actually get these kinds of things, not just because of technological advancements, but also because of financing. Usually there's a lot more credit card programs out there. There's buy now, pay later. There's all these kinds of programs out there which will make it easy for you to actually access TVs, cell phones, and all these other luxuries as you mentioned. But back then it wasn't as accessible as it is now. Now, the other aspect is the price of rent and housing has not kept up with wage growth. It has, the amount of wage growth that, let's say it's like 3 or 4% a year, it doesn't match the amount of basically rent and other items that have gone up between 8 to 20% depending on, the areas that you've lived in. So on average, the wage growth has not kept up, which has caused us to not be able to afford homes or actually rent. And in most cases, this is not something that has been addressed lately, but the only thing that we can do, sadly, in these situations is do more, sadly, than what our predecessors has done, where when our predecessors could just have one job, which is like as a teacher or something like that, and still buy a house, we sadly will have to have now 2 or 3 jobs just to have the ability to actually, get one home. However, alternatively, you can have one high-end job, and that should be enough in most cases, but some cases you might need at least 2 or 3 sadly salaries to make up for the shortfall of wages just not keeping up with this. This is the reality we live in, where luxury is seen as something that it's easy to grab, and that's why people sadly nowadays do go into more debt because of it. So this will conclude our reaction to TikTok episode 9. I hope everyone out there has a blessed day, and adios. Keep doing what you're doing. You're doing an amazing job, and I'm wishing everyone out there all the best. All right, until next time, adios.